Hey there, everyone. Welcome to my channel. My name is Ryan Schul. Just today, a little bit earlier today, I changed the channel name from Straight Data Science to Analytics in Practice. So if you're paying attention, um, you'll see the name change right there, right? And I want to do that basically to make the channel broader and not just focus on data science, which is kind of just a little tiny little itty bitty little thing. I think analytics is a much bigger opportunity, bigger perspective, and you can solve all kinds of problems, right? There's the data science world, there's stuff outside of the data science world that still consumes data. So I want to focus on just the big picture and big perspective here and not just be limited only to data science, machine learning, deep learning, things like that. I want the channel to be big, okay? So, so in the narrative today, I want to talk about counterfactual explanations in finance. So in a nutshell, there are ways to tip the scales just a little tiny bit and get things done. So if you were applying for a loan and the loan officer or loan approval individual, whatever it's called, they might say, well, you don't quite qualify for the loan and we're going to deny this, right? So there's no opportunity for the bank to make money, and there's no opportunity for the individual that's seeking to borrow the money to actually get the capital, right? But we want to look at this from a different point of view and say, well, maybe we can give you most of what you want, but not everything, or we can charge a slightly higher interest rate because this is a little bit of a risky loan or something like that. So the counterfactual piece is basically just tipping the scales a little bit to get things done, right? To get the business done. The bank wants to make a profit on the interest, and the individual wants that capital for some type of investment, whether it's a small business loan or auto loan or whatever, right? So you can have an in-between meeting of the minds. If you can't get exactly what you want, how can we make this work? How can we just massage a couple of things just a little bit and get this signed off on? Okay, so basically we're looking at customer transparency, right? Explainability, and know like what is the potential risk here for loaning the money. The accountability or actionability for clients, that's important. We're going to take a look at that. Loan terms, down payments. If you pay more on day one, maybe we can issue this loan, right? If you just want to pay 5%, maybe this is out of reach. If you give us 20, 30, maybe 40%, we can give you a loan for the rest, right? So there's things like that. We can just make these little tweaks possibly and get this thing done. So that's the goal today. Also, there's regulatory and compliance issues, auditing, consequences, right? These are things that we have to consider too. Model risk management, abbreviated MRM. So I worked in this area for a little while in one of the jobs I had. So just understanding the model, understanding what it's doing, are the calculations correct? I saw models that had literally very incorrect, like flagrantly incorrect calculations when I was doing this, right? So I reported that to the client I was working with, and they were grateful for that. So just because you have a model and it's spitting out information or spitting out calculations doesn't mean it's right, right? Like you have to make sure that the model is doing what it's intended to do. So business strategy and policy tuning, we'll take a look at that. Trying to understand any kind of unintended bias, right? That's important. I don't think we're really going to focus on that in this video, but in the back of your mind, you have to be cognizant of that. You have to be aware of these things, right? Scenario analysis and stress testing. So I have a couple videos that speak specifically to this topic. You can check those out if you're interested in that. We're just going to scratch the surface on that today. And then improved human AI collaboration, right? So this is how do humans utilize AI, embrace it, and leverage the potential of these AI solutions. And it can be very, very, very useful. It can be sometimes useless. You have to know how to use these tools, and you have to understand the results that you get from these tools too. Because I've seen a few times where they give you the wrong answer, and if you don't understand like comprehensively what's going on here, you could actually maybe use that incorrect answer in your model, and you don't even know that the calculation is not correct. And now all of a sudden the model is totally doing things that that you don't want to do, that you don't intend it to do, right? So understanding the big picture and being able to utilize AI in a way that's going to help you and not potentially hurt you, I think that's very important too, right? So we'll take a look at that, and just not to go off on a big tangent here, but let me see. I was looking at this the other day. Excel errors and cost. Is this a good way uh to look for these news? So this a few days ago, it was kind of alarming. The worst financial service Excel errors of all time. Okay, so this isn't AI, but this is a potential miscalculation in Excel. It's going to be very, very, very costly, right? If you don't catch these things early. 2 billion scale to Tesla Motors compounded error in the spreadsheet was made by leading and to an inadvertent discount of 400 million. Okay, if you make a $400 million mistake, that's a big mistake. This is 100 million, not quite as bad as the previous one, but still pretty bad. That's a big nasty pill to swallow, right? I heard about this back in 2020, 2012, the London whale. Miscalculations resulted in $2 billion of losses. So 2 billion, that is a big mistake, guys. It's a big mistake. So when you're when you're building these models, you have to be careful with what you're doing, right? Okay, so there are a few different features that I want to create here. A FICO score, loan to value, debt to income, loan amount. Is this loan going to be secured or unsecured? The age, term, and the APR of the loan. So these are all important, right? I'm not going to get into all the significance and the meaning of all of these terms, right? These are finance terms used a little bit in accounting as well. If there's something you don't understand, I would definitely encourage you to go Google it. I don't want this video to drag on for hours and hours, so I'm not going to try to define every financial terminology here that you see. But if there's anything here that you don't understand, you might want to post it in the comment section. I think if you Google it, you would probably get your answer way quicker than if you post it in the comment section or use ChatGPT, right? If you want to get more information about some of the terminology that I'm showcasing here, then by all means, use that. That's a great tool as well. Okay, so we have the features. I want to go ahead and put everything into a data frame. Okay, so my ultimate data frame will be called DF, and the simulation of these financial metrics are right here, right? So I have the FICO score. Oh, sorry, let me run this, Control Enter. This was from a couple of days ago. Run it just to refresh it. So we have the FICO, debt to income, loan amount, the payment, the APR rate. This is the annual percentage rate of the loan, right? The interest that we're paying on the loan. Probability of default, true, new debt to income. So we're massaging the debt to income a little bit, again, to try to get some of these loans approved and signed off on. And we'll see in just a couple of minutes how we can make that better, to grease the wheels for this loan creation machine. And is the loan approved? Yes or no? 1 is true, a 0 is false. So anything that has a 1 here, the loan is approved. Anything that has a 0, that is going to be loan not approved. Okay, so Control Enter to run. So the target probability that we're using for these loans is 0.58. Now that is a little bit arbitrary, but I think it's realistic. So any loan that comes in under that is not going to get approved, right? Any loan that comes in over that will get approved. So it's a little bit aggressive. It's pretty safe for the bank when you pick a target close to this number. But we're going to see in a few minutes, if it does come in a little bit less, that is the whole counterfactual argument that I'm trying to make here, right? Like, we can massage some of these numbers. We can make these loans work. We can give you the money. Might be less than you're asking for. The interest rate might be higher. Maybe we need a shorter term for the loan. Maybe we need more money down. But there's little like levers that we can pull. There's little dials that we can kind of dial in a little bit just to make these loans work for our institution, right? The lending institution, or for the client that's borrowing the money. And I don't even care which side I'm on. I could work for the bank. I've worked for about 10 different banks. I could be the guy applying for the loans. I've had 3 different mortgages in my life, right? So I don't care what side of the what side of the situation I'm on, but I'm just trying to make it more flexible, right? So business can get done, so liquidity can be adjusted and delivered to the borrower because that's what they need for their small business, for their car loan, maybe down payment on their first house or whatever, right? Well, like whatever the money is being used for, that's kind of um, irrelevant here. But we want to see what dials we can twist or levers we can pull to make these loans, um, you know, what's the word? Affordable for the customer and actionable for the bank, right? So that's the whole goal here. So we have the loan amount, income term, loan to value, debt to income, okay? And we have the actions over here that we're trying to accommodate for the bank. And then the cost, right? The cost of doing business is down here. So these are just some data points that I'm coming up with. Now, this is synthetic data. This is very realistic. These amounts, these income terms, APRs, LTV, DTI are all very realistic. I don't have actual loan data. And even if I did, that's probably very confidential and very personal for that business. I don't think you're going to find loan data online. I didn't even look because these are people's loans, right? Like it's very, very sensitive information. Maybe you can find some hypothetical from, what is that? Kaggle or something out there might have something. I'm just making my own. It's easier for me. But you're not going to have real client data. But actually, if you were doing this for the bank, you would use your own data, obviously, right? Like you don't need synthetic data. You need real historical data from actual loans that you have initialized or whatever that you have offered in the past. Okay, so Control Enter to run the code and the cell. I'm setting up a couple user-defined functions here, and I'm going to dump in all that data that I just showed you down here. Some of the main takeaways here is the target, the 0.58. Now that is a probability that this loan is going to be paid off. So higher is better, lower is worse, right? We want something closer to zero, but we can go a little bit lower than that. We know not every single loan is going to be paid off, right? There will be some write-offs. There will be some bad loans that the bank makes or the lending institution makes, and they'll never get the money back, right? So it's never going to be 100%. This is the top K, the beam width, and the maximum depth, right? So all of these features right here, or all of these parameters are adjustable, and you can dial those up or dial those down to be whatever you want, okay? So moving forward here, we're going to go ahead and look for a feasibility outcome here, given the data input that we collected over here, okay, all the metrics for the loans, and then the actions that we're going to take, and then the cost of doing business for this lending institution. Okay, so I think I just ran this. It should be fine. There's no feasible plans that passed 0.58, right? So this threshold is kind of high, and it's preventing us from doing business, right? But the baseline probability is about 0.468. Okay, so can I find that over here? Oh, I don't see. I think that's for everything. The baseline probability is 0.468. So these loans right here are getting pretty close to that 0.58. So anything over 0.58, automatically we will issue the loan. These are a little bit under, but it's actually pretty close, right? So 0.51, 0.509, 0.504, 505. And then we have the cost associated with each of these loans, the income, change in income, loan amount, change in loan amount, loan term, and debt to income. Okay, so you can see these over here. So we see the best 5 plans. And basically the way to interpret this is like the ranking is best to worst. So these are the customers that we would reach out to first, okay? These are not perfect customers, but more likely to pay off the loan. These guys are more likely to pay off than some of the kind of like whatever it's called, deadbeat customers or something that's might actually not pay off the loan, right? So these are the top ranked potential customers that we have right now. The probability is the model's approval probability after the change. The cost is basically the score from the weights from lower loans to modest extensions. Anything that's expensive is going to boost income, but if the loan gets too expensive, maybe the customer won't be able to afford it. Either the APR is too high or the down payment might be too high, right? And they can't even get a foot in the door. So the client might not even be able to take these loans actually. So for instance, you have line item number 4 over here. You can see the probability is 0.510. Okay, and the cost is 1.7. And number 3 change. So basically, the changes are 10,000 increase in income or negative 10,000 less loan, or the term goes from 36 to 60 months, right? So 60 months would be, that would be what? 5 years, 36 is 3 years, right? So maybe this bank is saying, okay, 36 is too short for us to lend you the money. We want to draw it out so we can make more interest payments. Now, that's going to be more expensive for the customer. But if the bank says, listen, 36 is just not doable, we're going to draw it out. And instead of 3 years, you have 5 years to pay off the loan. So it's more expensive, but otherwise we just won't give you the money. Okay. So this makes it more alluring for the bank, or more enticing for the bank, less enticing for the customer. But if they need that loan for an automobile, maybe the customer is going to do it, right? Then they both win. If the customer says, no, 60 months is too long, I need 36, that's it, I can pay it off in 36, I make good money. That's great for the customer. The bank is going to walk unless they get what they want, right? So that is the point of this counterfactual argument that we're making, or counterfactual logic that I created here, right? So like, how do we make this work so the bank wins and so the client wins? And how do we just tweak these numbers just a little bit so everybody gets what they want? Now, the bank makes more money, right, at 60 months versus 36 months. The client is paying more now for the same loan. But again, if you want that car, if you want to do business with the bank, you're going to have to comply with the bank's requirement. Okay. So 0.58 we said is mandatory. None of these probabilities get to 0.58, but they're kind of close. So they're still being considered for these loans. So hopefully that makes sense, right? So we can also allow lower or larger loan cuts. Instead of maybe 30,000, we'll only loan you 20,000, less risk for the bank. Now less opportunity to make interest, to collect those interest payments, right? Because you're not lending 30,000, you're only lending 20,000. So it's less for the bank, but less risk for the bank too. So now anybody is more likely to pay off $20,000 loan versus a $30,000 loan. I don't care who you are. It's easier to pay smaller amounts than bigger amounts, right? So if the bank comes back and renegotiates, okay, we'll give you 20 instead of 30, you might just say, okay, it's good enough. I can't afford that like brand new car, that brand new Honda Civic or something, because I can't get the 30K, but I can get a vehicle that's a couple years older. I'm just getting 20K. So still everybody wins. Okay. So that's what we're looking at here. Control Enter to refresh this chart. I always say a picture is worth 1,000 words. So we're taking everything that we just calculated above and plotting this over here. So you can see the cost to the bank is 1.45, probability is 0.504, and the number that changed is 3, and this is ranked number 1. This is ranked number 5. The cost is 1.85, and the probability is 0.509. And you can see that over here, 1.85, 0.509, right? And this is item number 5. It looks like a 4 here, but we start with 0. Python is always 0 based, so we just start with 0 and go up to 4, and those are the top four opportunities for potential loans from this lending institution. Okay, so basically the chart shows you the trade-off. If I let the borrower adjust their profile just a little bit, how much approval probability can I buy for a given cost? In this case, you improve from 0.468 to 0.51. Now we didn't reach the 0.58, but we got a little bit closer, right? So now we can probably get this loan on the books, so the bank is making money and the client gets the loan, right? So the model basically thinks this is fundamentally too risky, right? So it's ranking this as 0.468, but we've made a couple adjustments to get up to 0.51, still under the 0.58, but we're definitely in a better spot, okay? The bank is going to lean towards this right here at 0.51 rather than this. So if you need to expand the search space, larger income increases, bigger loan cuts, maybe improved FICO scores, loan to value, so that could be lowered, right? The loan would be a little bit smaller amount, or debt to income. If the person has a lot of debt right now, maybe require the person to pay off one or two other loans. They could have other loans with the same bank or other banks, right? If a person has 5 different loans with 5 different banks and another person has no loans with any banks, probably the guy with no loans is in a better position to pay off this bank if he's coming to us, right? The guy that already has 5, he already has 5 cash flow streams going out to service these other loans for other institutions. We're probably not going to give the money to that guy, right? So we're looking for LTVs, DTIs, things like this. The x-axis shows you how expensive this is, right? So we start at about 1.45 and go up to about 1.85. So that is the cost to the bank. So this is expensive or disruptive, or it's based on customer cost function. So raising income, lowering loan amounts, extending the term of the loan, right? Going from 36 months up to 60 months. We saw evidence of that. The y-axis basically shows the predicted probability of loan approval, right? So the y-axis says this is about 50% likely to be approved. This is about 50% likely to be approved. Again, we'd like to get closer to 0.58, but nothing reaches that mark, right? So these have to be looked at a little bit more closely, and a different type of consideration needs to be made for these loans because nothing in the whole data set is at 0.58. We just don't have that. The bubble size shows how many features had to change. Smaller is fewer, and this is just easier to get this done. If the bubble size is bigger, there's going to be a lot of things that have to change. The DTI, LTV, FICO scores, things like that. FICO isn't really going to change that much, but again, the amount that you loan or the term of the loan could increase. So there's a few things that you can tweak. What else? The leftmost bubble is ranked number 1. So on the left-hand side of the chart, we see the 1 over here. This is probably the best loan in the entire universe of potential loans that we're going to make. The number that changed is 3. Probability is 0.504, and the cost is 1.45. And that's exactly what you see here. Probability 0.504, and the cost is 1.45. So that looks good. And number 2 is kind of sitting right on top of 3 over here. So these two are kind of together. And then we have 4 and 5. These are the top 5. So basically, the probability is about 0.51 of these loans getting approved. So almost 50-50. They could be approved, they could not. But again, we can tweak those features and adjust the dials just a little bit just to get this over the finish line and to get these loans approved. So that's why we're looking at counterfactual explanations, okay, to see what small change we can make to have a big impact, either the loan getting issued or not issued, okay? So that's pretty much it. Kind of interesting topic, a little bit complicated, convoluted, right? But I think pretty interesting nevertheless, okay? So that's it. I'm going to wrap it up here. We're at about 23 minutes. I think it's good. I think it's good for first pass. And yeah, that's it, guys. That's counterfactual explanations in the world of finance. That's my take on that anyway. So yes, I'm going to wrap it up. Thanks for your time and attention today. I really appreciate it. And I'll see you guys when I make the next video. Thanks for this today, and I'll talk to you soon. Bye.